We're gonna use this one for questions, and then you can grab this live one here.
That's fine.
Yeah. Ron will use that one. So Ron's gonna probably sit there. I'm gonna slide out. Want to sit here?
Since we're here, Ron.
Nobody else is showing up.
Oh, thank you.
Nobody else is showing up.
Oops.
They should come just to come.
Some people will.
But it is dark and it's very cold.
Why that happen?
I should have called Joni. Maybe she would have came if I picked her up.
She said she responded right away that she was gonna come in on Zoom, but I'm not.
I don't know what happened here. This is fine, but it's showing that for some reason.
Think it just said yeah. For some reason.
I don't know. I wasn't signing on the TV. I'm fine here. Everything's working on. It's just showing.
Oh, maybe try to the input.
Anybody watch the Global Wars?
I missed it.
I only have those channels, but it said it was streaming in Paramount, but I think that means like today. I don't care. Did
I used to get things straightened out, you're streaming?
Uh-huh.
Still trying to get the technology going here.
No, we're working fine. It's not showing on the TV, so.
Oh, is it showing on yours?
We can't see the people.
Oh,
I want
Oh,
to see
See
the
them
crowd.
anyway.
I want to see the crowd.
yeah.
It's not like a Zoom call where they want it on there. You don't see anything.
Is this okay like this, Gino?
Yeah, sure.
Then I'll just put this in
Yeah,
here.
Ron's gonna have to talk to a green screen.
I'm here.
Give you a little
Oh.
Hi, did you talk?
Thank
He
you.
said he got stuck at work. He just called me like 5 minutes ago, but he said he could talk to you tonight.
Okay.
So if you want to try him again, maybe not right now,
Okay.
but as soon as we finish up.
Okay.
He was trying to explain to me that he might have, it sounds like he might have a tenant in the building there in the house. There's some pizza here if you want some pizza or salad, if you want to grab some later, or a soda. You want a soda? A couple of minutes. Do you want a Coke or a Diet Coke or a ginger? Okay.
Hey, please, how are you? Happy New Year.
Thank you so much. Happy New Year to you.
Ron, how's your dad doing?
You know, thankfully he's doing okay. He's doing all right. You know, his days when he does dialysis, he's pretty wiped out. But his other days, he's okay. I mean, he takes my ma to the store. And
Pizza.
my ma's got the one, you know, she's the one that probably has the tougher job because she's, you know, cooking and cleaning and doing all the
Ron,
housework
this is
and
Lillian.
stuff.
I don't know if you ever met Lillian before. This is Ron Ricchio.
Hi, Lillian.
How are you?
Good. How you doing? Yeah, let me get one of these.
Somebody else said they're on the stream.
How are you?
Thank you.
Tiffany, do you have Tiffany in there? Okay, let's go.
Sorry.
Oh,
I was just it's gonna be too hard to.
who do you have on? Who do you have checked in there? Just so we know. You know,
Tiffany and Molly.
Joni Kinnicky.
Larry should be joining, he said he was. Larry said he was gonna try to join the
It
Zoom.
says there's 6 people, but I can't see who it is for some reason.
Okay. Just don't want to leave anybody out that said they were going to be on. You're recording anyway, though, right?
But Michael, at the end, like, we have- he probably doesn't
leave a couple of, I'm going to direct everybody else that comes in over that way, so.
Like I was laughing
All right.
about the little red Solo cup.
Yeah.
I'm just going to really just touch upon
Yeah,
some of
good
the new
evening
things.
to all that are watching us online and also live in the audience here. We'll have a few more still attending. Hopefully everyone is connecting. We're have Gino working on the technology. So if you need to be in touch with us and you want to check in on that, you can text me to make sure we have no issues and that you're picking up the information. So introductions are not really needed here. Most of you know Ron Ricchio, who's our speaker this evening from his longtime affiliation with the company. And we have certainly appreciated his participation in our new series. So we're calling this the Expert Series, and approximately once a month, sometimes maybe a little bit longer, sometimes shorter, depending on availability for speakers. We want to engage individuals that can bring some good information to all of you. We want to keep the information period kind of on the short side, probably not any longer than maybe 45 minutes or so, on that. And we'll try to get everything completed within the hour here. We want to have availability for questions. So if you have any questions, feel free to shoot me a text. I'm live right now at my phone number, and I can get a question out to Ron. But Ron's going to be providing us with the content tonight, and we're very excited about having him come here tonight to share with all of you. And this will be recorded also, so if you need to miss out on a part of it because you're working on a sale, then certainly we'll be in a position that we can get you the information. Gino will distribute that within the next 24 hours or so. That should go out. Did I cover everything we need to cover right now, Gino?
You got it.
Okay, without further ado, then we'll shoot it over to Ron Ricchio, our guest speaker for this evening.
Well, thank you, George, and thank you, everyone. I think it's been probably close to 15 years that I've been the
Wow.
preferred lender. Time flies when we're having fun, and I have to tell you how much I really enjoy working with the office and with you guys here. So
It's okay.
really tonight I'm going to provide some content on just some new programs that are coming out, some potential changes that are in our industry, and then I'm going to talk a little bit about what's happening in the marketplace, where we're seeing interest rates going, some predictions for what's going to happen maybe with the economy, unemployment, inflation, real estate appreciation, and whatnot. So let's get right to it. So Happy New Year, everyone. Some of the new things that are now changing now in the new year, we have some new loan limits. So the new conventional loan limit is now $832,750. And the FHA, this is for single family homes, the FHA loan limit is $541,287. So just to show you how long I've been in the industry, when I first started, the jumbo conforming limit was $181,500. So now with it being $832, it's quite some time. I'm starting my 35th year. But what's nice about this is a reflection of home sale of appreciation in terms of the market. So really, I think on average here in the last 5 years, we've seen on average in the country about a 50% appreciation on prices. So as prices appreciate, these have to go up. The only time we really didn't see them go up was during the financial crisis, where they just held them steady for about 4 years before they continued to go up. But this is really nice because we normally see a lot of clients that make enough money, they cash flow well, where they're making good money. They have a tough time saving money just because of where inflation is right now. So that means that somebody could buy an $850,000 house and put down as little as 5%, and you could get a mortgage that would be, today potentially at 5.99% on a 30-year fixed. The same thing with FHA. FHA, the loan limit's $541,000. Their minimum down payment's 3.5%. So if you looked at something around 560 or 565, you could put down 3.5% and you would hit this loan limit, which is really good. Typically, you don't need any reserves on a single family purchase. Typically, reserves come into play when you have when you're looking at multi-units. So this is really nice to see. It's really helping out in terms of especially these higher home prices. One of the products that we're looking at that's starting to getting a little bit of traction are these buy downs. So if someone doesn't know what a buy down is, that's where you are basically taking the interest rate 2% below where the market rate is at right now. So let's say the market rate today is at 6%. On a 2-1 buy down, the rate would start at 4% year one, go up to 5% year two, and then year three would be at 6% through the duration of the mortgage. So how do we figure that out? How do we work with this? And what's the benefit to that? Well, the benefit is that you're going to be giving somebody a lower mortgage payment at 4% for the first year instead of 6%. So that typically will help people get into a property, and hopefully then with just appreciation and what they're going to get in terms of increases in wages for inflation, that might help, compensate for when they're going to see their payments go up higher. But the way that a buy down works is that we figure out the difference between the 4% and 6%, between the start rate and where the end rate is going to be for year one. And then we go to year two, we figure the difference between, let's say, a 5% and a 6% rate. So let's say year one, we're saving $300 a month from the 4% to 6%. And then let's say year two, it's going to be at $150. So when you add all that together, the difference in the payments is about $5,400. So who pays for that? So that has to be paid for by the seller. So that has to be a seller concession. It could be a seller concession in terms of just a seller credit to pay closing costs, to pay buy down. There are some limits as to how much can be paid in terms of a seller concession. So typically you're limited to 3% of the purchase price when you're putting down less than 10% down. After 10% down, you could go all the way up to 6%. But this is something nice that for a while really didn't gain much traction because there were so many offers that people were not even considering a seller concession. Now what we've noticed here in the last quarter is that, at least my business, I've noticed that we're seeing more FHA, VA buyers with 3% down or 0% down loans or financing get approved, where 6 months ago there was so much competition that they wouldn't even look to somebody who had maybe non-traditional or non-conventional financing. So these are things to kind of keep in mind. If you have a property maybe that's not moving, maybe one of the ways to entice it would say, hey, my seller is willing to pay X amount of dollars to give you a 4% interest rate for the first year. And that may perk up somebody's interest in saying, hey, I'll definitely take a look at that. So those are things now they're starting to kind of come into vogue a little bit more as we see, prices moderating. And I would imagine, George, are we starting to see on your end prices moderate a little bit here, at least in the fourth quarter?
It's really a case-by-case basis because we're blessed that we're in a very affordable area here. And when you have affordability, that means usually that you're going to have not as many, more buyers that are seeking those affordable homes, which means that there's going to be a little bit more competition. As you go up the price ladder, it seems that there's going to be less buyers that can afford the higher price. So they need to be a little bit more aggressive, probably on a seller side. So it's kind of a case-by-case basis, of course, always based on the competition, and it's always based on the condition of the property itself. But I would say in general, yes, that there has been more of a balancing of the marketplace, which was in the last couple of years heavily tilted towards the seller market. Now it seems like it's starting to move more towards equilibrium, more towards a balanced marketplace. But I'm not ready to declare that yet, because again, we're in the downtime of November and December. We have had agents recently that have listed properties competitively that is still in the first few days of being on the market has seen double-digit showings and then multiple offers coming in. So again, pretty much case by case, I think, at this point.
Yeah, and I mean, it'd be nice to see a market that's more normalized, but we are going into the spring market. We have seen a little dip in terms of rates recently, which kind of leads us into some of my other topics that are coming in. And when we talk here about the Federal Reserve, we've got a Federal Reserve chairman currently that seems quite at odds with the president. And he is, I think, reluctant right now to lower interest rates more currently. At our next meeting that's coming up is going to be at the end of January. And we recently got a jobs report just on Friday that talked about what happened, for the previous month, the month of December. So they were expecting around 73,000 new job creation, and it came in about 50. But the revisions to the prior months were lower than what was expected. So we actually had a negative number in the month of October. So it was over 100,000 negative job creation in October. And in November, it got adjusted to 56,000, and it was negative 173 in October. So it was a pretty weak jobs number. The actual unemployment rate went down from 4.6% to 4.4%. And people might ask, well, if we had such weak job creation, how could the unemployment rate go down? That's all about participation. So it's two separate reports. One looks at what's called the birth-death model, where they look at small businesses being created and small businesses going out of business and seeing there's an estimate as to how many jobs are created. And on the flip side, the actual unemployment rate is where they actually call different households. They call over 50,000 households on a monthly basis, actually asking them the questions. And if you're not actively looking for work, if you're being taken off, then the participation rate is lower, which could artificially push the unemployment rate down, which brings it to be a little bit misleading in terms of where that unemployment rate is. We have definitely seen.
This is in contrast to what we've seen, though, for the last couple of years on job creation, though, correct?
That's correct.
Okay.
That's correct. So there's a separate, so the department that does all the calculations for the jobs report is called the Bureau of Labor Statistics, the BLS. So the BLS on a monthly basis will gather all this information up, where they have this birth-death model, and then they have this household survey, which incidentally hasn't really changed the way that they calculate things since 1985. So it's 40 plus years that they really haven't made a change, and they should make some changes. But there's a separate auditing department that actually audits the BLS called the QECW. And they came out and said that there was over 800,000 jobs that they said initially were created that were actually not. So the QECW comes out, and their reporting is probably about a year. Their lag is probably about a year. So the most recent one we had was from the second quarter of 24 to the second quarter of 25. And they said there was over 800,000 less jobs created than initially were reported. And that's concerning because the stock market, the bond market reacts to that headline number. And when we get these revisions that come out, either the following month or 2 months, there's typically a 60-day revision period. They don't seem to get as much traction. But we're definitely seeing the job creation number trend down. We're definitely seeing the unemployment rate go up. At the beginning of 2025, the unemployment rate was at 4.1%. I had done a video back in March of 25 where we did some of the predictions for what we were seeing. And I predicted we were going to be between 4.5 and 4.6 at the end of the year. We actually hit 4.6 for December. And none of the Fed presidents really thought that it was going to be over 4.4%. This year, I think we're going to trend up closer to 4.8 or 4.9. So we're going to see what's going to happen here in terms of that. Some of our inflation numbers, we were hoping that inflation was going to be down a little bit lower than what we initially thought. Inflation ended up at about 2.7% for the year. And the Fed's got a number of different gauges. They've got this PCE, this personal consumption expenditure index. They've got the CPI, consumer price index. But on average, we were right around 2.7. We were hoping to be below 2.5 and around 2.3, but because of tariffs and whatnot, partially because of tariffs, partially because of just the market in general being where it was at, we didn't see the inflation come down as low as we had hoped for. So kind of moving on here, I want to talk to you also about where we're thinking rates are going to go here. So just recently, on Thursday, President Trump announced for the GSEs, Fannie Mae and Freddie Mac, to go out and actually buy $200 billion in mortgage bonds. So what this is very similar to what happened during COVID, where the Federal Reserve actually went out and they called it quantitative easing, or QE, where the Fed actually bought mortgage bonds to artificially push rates down. So not only mortgage rates, but treasury rates in an effort to stimulate the economy. So what the president is trying to do now, he's trying to push interest rates down to make things more affordable for home buyers. And I think that what they have to do, and this may happen when we get the new Fed chair in May, there may be an even bigger program of buying bonds, or QE, in order to push rates down closer to 5%. Right now, we're hovering right around 6% right now. Why do we think 5%, or why do I think 5% is a key rate? Is because we have a big percentage of people that bought homes in 2020 and 2021 that have rates that are at or below 3%, that they call the golden handcuffs. So people don't want to move. So even if they're busting at the seams, or if they've outgrown their house, they don't want to move because they don't want to lose the interest rate. And it's very difficult for somebody to say, hey, I'm going to sell, move, and lose my 3% rate to go up to 7 or even 6.5. But it's a lot easier for them to go from 3 to 5%. So I think that there's a chance that whenever the new Fed governor, the Fed president, chairman comes in, there's a chance, I think, that they could make this campaign that he's talking about something that they try to do for 6 months to a year in an effort to kind of loosen up some of that inventory. So I think me and George had talked about inventory here over the last few years. Over the past 3 years, we've been hovering right around 4 million existing home sales per year on a national average. Pre-COVID in 2019, we were at 5.5 million transactions. So because of these lower rates of where we're at, these golden handcuffs, we've lost about 1.5 million transactions. Part of that has brought prices up because there's too few properties for all the demand that's out there. And it's hurt everybody's sales. We have the demand, a lot of people willing to buy, but we just don't have the inventory that's out there. So I think that there's a possibility that can happen. The fourth quarter, as I was telling George, what I saw, we saw some normalization in the market, but that could have also been seasonal because we were in November and in December. Now, if we see rates come down, we're right around the corner from the spring market. There's a chance that we're going to see, the multiple offer saga that we've been seeing over the past few years. So that'll be one thing to kind of keep in mind and seeing what happens. So that'll be a work in progress. I'll keep you guys posted on that as to what's going to be happening.
As Ron notes on that, when you have a deficit there of approximately 5 million homes in a normal year to 5.5 million homes, and we've only been getting in the neighborhood of the very high 3s or 4 million cumulatively now for at least the last 3 years. Yeah. So the deficit is, when you add them all up, it's 1 million to 1.5 million per year for 3 years. So we, in theory, and this is again theory, there's potentially pent up demand of 3 or 4 or 5 million sales that did not happen. And at some point, they likely will happen unless individuals just defer and go into rentals, which they may and have done actually short term, but it's not probably getting ahead of the curve when you're paying the rents that are being charged out there in the marketplace. So the cumulative effect of all of this thing is, I think that good things are going to be on the horizon. Are we going to catch up right away? Probably not. But we still are going to be in a catch-up mode here, for a while, which means that those that have been hanging on here are in good shape if we just stay the course and we follow these buyers, that are out there that perhaps have been looking and dabbling, but now hopefully are going to be serious is when they get the opportunity and it presents itself.
And there's a lot of things that are happening too that are, I think the current administration is really focused, pro real estate. I'm sure you guys have heard that they want to eliminate big corporations from buying residential real estate. So the Blackstones of the world that have been buying all this real estate, they want to be able to prohibit them. I don't know if it's going to be something that's going to be temporary or if it's going to be permanent, but they really want to prohibit them from being able to buy single family homes. FHA has been doing that for years. So if FHA takes a property back in a foreclosure, when they put it back up for sale, the first 30 days is for owner-occupied people only. So I think if they were to institute something like that, it gives that first-time home buyer, that move-up buyer, an opportunity to buy a house as opposed to a big corporation swooping in and buying all these homes. I don't know if that's going to affect us as much in our areas here, just because I think it was more prominent back during the financial crisis where there were a lot of foreclosures that were going on. But it will help to bring some more potential inventory to market if there's less big companies out there that are bidding, and usually they're bidding on blocks of properties that are out there. The other thing that could be helpful too is that there's a lot of talk that they may lower the credit score requirements. So after the financial crisis, we had all these changes to where you had all these different credit scores. So right now, for you to get the best credit, the cheapest interest rate at the cheapest closing cost, you have to have 2 out of your 3 FICO scores, Equifax, Experian, TransUnion, at or above 780. And then it goes down in increments of 20. So then it goes from 761 or 760 to 779, 740 to 759, 720. So every 20 points is another category that you go down. So every time you go down, it either gets more expensive on the rate or it gets more expensive in the cost. There's been a lot of talk that they are going to eliminate that. So it used to be years ago, some 15 years ago, it was if you had a 620 or higher, then you got the same rate as if you were 800. So it could make it cheaper for people to buy homes. So I think the fact that they're trying to push rates down, we're trying to eliminate big corporations from, potentially bidding up these homes, making credit scores more reasonable for buyers. These are all great things that potentially, could make a really nice recipe for a good real estate market for the year. So we're going to see what's going to happen with that. There's also some talk that Fannie Mae and Freddie Mac may go private and that they go public, that they may go public, and they are already public, but they may make a mass IPO out of both Fannie Mae and Freddie Mac. I don't think that as long as they have the explicit backing of the federal government, we're not concerned about really rates moving up from that point. But I do think that there's a lot of things that are definitely going to be helpful.
Well, Ron, you get around and you talk to mortgage brokers, buyers, sellers throughout different parts of the country. So I think one of the things that we should note is that we've been very fortunate in our Chicagoland marketplace that we never had excessive appreciation. We've had good, solid appreciation, as we've discussed, but it never got off the charts high. And so, as they always say, what goes up must come down. So I think maybe I see one of your comments about looking at other marketplaces. We do have a lot of individuals that are looking at relocating to other parts of the country. And perhaps over the last few years, they've been challenged because some of those marketplaces have been boom markets and have really appreciated a lot. But those now are having some challenges there. Any comments on that, Ron?
Yeah, I'm actually licensed, also in the state of Florida and Michigan. And this past year, we've probably done about 10 deals in Florida. And the second half of the year, maybe even after the second quarter, we are seeing people that are buying properties down there that are in some of the markets are declining markets. So as George said, they saw some really skyrocketing prices, and now due to being overbuilt, Florida also has some insurance issues to where insurance prices have gone through the roof, and some people just not wanting to stay because of what's happened with just the climate, just the weather and the hurricanes. They've had a huge impact on condos. So if you have condos that are within a few miles of the water, and if you're above 2 stories, you have to have the special reserve study inspection that if it found any structural or safety issues, that has to be fixed, because we all recall about what happened back in Seaside, Florida, back in 2021 when the condo building went down. There was a bunch of changes that were made, even with Fannie Mae and Freddie Mac, that now there has to be higher standards for structural and safety. So that's brought on a lot of additional assessments down on a lot of these condos, and there's a lot of people that have moved there either for retirement, retirement, or for a second home that now can't afford these properties. So we're seeing in some areas, and some areas are still doing well, but in some areas we're seeing just a lot of inventory come to market, and it's pushing those values down. So it's a much different market in Florida than we are here. And again, there are some hot areas of Florida they're still maintaining very well, but there are some pockets where we're seeing some declining values that are there.
Well, I know that I've had at least 3 or 4 clients that have remarked that they would like to sell their home here, but they have been looking at a relocation and it's been too expensive, much more than they anticipated moving out of the Chicago area, so they've stayed put. So if we start to see, in my opinion, some of that balancing, and I think Texas could be also certain parts of Texas. There's been a lot of overbuilding across the South. There's been a lot of building. Arizona. So those desired spots for the Chicago clientele, if those prices start to moderate and come down there, it will alleviate our market, because we're still in a relatively healthy marketplace here, and it may free up other opportunities that haven't existed for the last 3 or 4 years. So just something to kind of share there, because that's what I'm seeing and hearing when I'm out on the road.
Another interesting point that was brought up about inventory and why I think we're not seeing the inventory come to market. We talked about people that are in these golden handcuffs that have lower rates, but there's also another percentage of sellers that have no mortgage. A lot of them that are either of retirement age or close to retirement age, that maybe have been in their homes for 15, 20, or 25 years, that now are concerned that if they sell, if they have a market, if they have a gain of more than $250,000 if they're single, or more than $500,000 if they are married, that they're going to be taxed on that. So that law was put into place more than 20 years ago. So that needs to be adjusted. If that gets adjusted higher to somebody's primary residence, now if they sell, and maybe they have to raise it to $750,000, or maybe they have to raise it to $1 million. But if that primary residence, then if they are able to sell it and not have to pay any tax on that gain, that potentially will turn around and maybe bring some more sellers to market in that senior class, in terms of, people that have these huge gains, but now they're worried about selling because then they have to pay capital gains. So I'm hoping that here we're going to see some of those tax laws get changed for that specific rule about property tax gains on your primary residence. And hopefully that'll hope to loosen up some inventory, because it'd be good to see real estate values go up the same as income. So that's typically and historically how you see it. So if your pay goes up 3%, real estate values should go up 3%. And I think that's where they came up with the 3 to 5% historical rule for real estate. But I think in 2020, we had a 18% appreciation. In 2021, we had 15%. This is on a national average. In 2022, it ended up being just under 9. It's been trending down, but once they go up, it's really hard for them to come down, especially if we have demand. So hopefully we'll see a lot of these things come into play. It'd be nice, I think, if we had more of a normalized market. I think we would all do more transactions if we could see more sellers come to market. So hopefully all this will come together. Some of my predictions for the year, for 2026. Currently, we're at about 4.4% on unemployment. I think, unfortunately, we're going to see that go up. I think we could be somewhere between 4.8 and 5% for the end of the year. We are seeing job creation, as we talked about before, trending down. They're calling this a low hire, low fire environment, to where there's not a lot of people that are hiring, but there's not a lot of people that are firing right now. They're worried about that. It also is a bit complex because we're not seeing on a weekly basis. Every Thursday, there's a weekly jobless claim number that comes out. And it's been trending around 225,000. Normally, when you would see them trending at 300 or 325,000, you would see job losses, you would see unemployment go up pretty significantly, potentially be on the cusp of a recession. Right now, I think they mentioned that the average unemployment weekly benefit is $467. So there may be people that, if they're losing their job or jumping into what they call this gig economy, where they're doing Uber or DoorDash or doing something else that's going to be able to get them some money that is more than $467 per week, because they probably can't live on that. So that's what's kind of skewing our numbers. But we are seeing unemployment trending up. We're seeing job creation trending down. We are seeing consumers that are pretty tapped in terms of credit card debt. So at some point, the consumer has to begin to pull back a little bit. And that potentially could help, bring interest rates down. Right now, there's some economists that are talking about consumers, that there's a percentage of consumers that are kind of at the edge of financial cliff. And then we have others that are doing very well. So it really depends on which bracket you're in. But we'll definitely keep things, keep you up to date on things. I do that weekly update in terms of what's going on with rates and what's happening in the market. In terms of inflation, core inflation, we were hoping it was going to be closer to 2%. We think that because of where we're at right now with tariffs and whatnot, that we're probably going to remain around 2.5% for the end of the year. The Fed likes to be closer to this 2% target. But there's talk that maybe they may kind of adjust that to be more of a range. There's a lot of people, the president included, that are thinking that, Jerome Powell and some of the other Fed governors are keeping the market too restrictive, that they should be cutting rates, that we have to anticipate what's happening in terms of job creation trending down, and that they're ignoring some of these signs. What happens if we go into recession, or we see job losses, at a rate that's higher than expected? Unfortunately, then we will go into recession, and then the Fed will have to act a lot more quicker than we have now. And people always ask me, they say, well, when do you think, will we have another correction in the real estate market, or when will we have another correction? And right now, I'm not seeing that in terms of what's going on. If we did get some really, really high levels of unemployment for a sustained amount of time, that's typically when you would see foreclosures come to market, and then we could potentially see an imbalance. What the Fed demonstrated to us during COVID is that if you bring rates down low enough and you're working, you're going to take a chance and buy a house. So that's the one thing that I think the Fed has got in their back pocket, is that we've just seen what can happen. And, if we go back to COVID, unemployment hit 14.1% in June of 2020. So at one point it hit really, really high. I mean, we're at 4.4%. So I know that they've got some tools that could help out. We don't have these risky mortgages like we did before, back in that range, probably in the early 2000s, all the way up to 2008. So I think from that perspective, we're going to be okay. I think overall, from a national average, I think we're going to be around our historical averages in terms of appreciation. I think we're going to be around 3 to 5%, depending upon the area. Now that takes into account some negative, like you were talking about, some areas like maybe in Texas or Florida or Arizona, and then it's going to compile that with some of the positives that we have here in the Midwest, because I know that there's areas here just in this greater Chicagoland area that even this year has probably gone 10% plus. It just depends on the town that you're in and the demand that's there.
Right. Yeah, one of the statistics that I saw tossed out was some of the best places to move to and the best deals that are out there, and Iowa pops on the list.
So Hawkeyes.
There are a lot, and I'm sure downstate Illinois, is similar. Probably parts of Indiana, as you get more rural, that are out there where these home prices are still very much below the national prices. So as individuals look at these places, there are great opportunities for real estate in those places, because if you can still go out and buy something in our marketplace for $300,000, but maybe in the middle of Iowa there's something out there for $150,000 or $180,000 with lower taxes on many of these places, then that's why those statistics are popping up there, and places that you really wouldn't anticipate till you look at the list, and it makes sense why they would, because they're so undervalued when it comes to the national scale. On that.
Yeah, I think areas like, and we saw this, I think, over the past decade or so, you get areas that have a milder climate. Like there was this big rush to states like Tennessee,
yep,
where they had a milder climate than where we had here. Taxes were very low. Real estate values were a lot less than here, that were very accommodating to people that were retiring or on a fixed income. So I think other areas like that, like you were mentioning Iowa and other areas of the country, are going to be very, very similar to like a Tennessee that happened here in the past 10 years.
Well, let's check in with any questions that we might have from our live audience here. Do we have anyone with a final question for Ron as we edge towards the finish?
Well, I think the other prediction I want to make, I think we're going to have, I think the Fed's going to do 3 quarter-point rate cuts this year. So I think we'll end up doing that. I don't think there's a Fed meeting at the end of this month. I think we're kind of gridlocked right now based upon what we're seeing. I don't think that they're going to move rates at all. It's such a division within the Fed that we've got some that are very hawkish, very much inflation fighters, some that are very dovish that don't really want to push rates down. But I think that later on in the year, I think that we were going to get at least 3 quarter-point cuts that potentially will bring the Fed funds rate down closer to around 3%. And usually the prime rate is about 3% on top of that. So if the Fed funds rate comes down to around 3%, then we're going to see the prime rate at about 6%. Currently, prime's around 6 3/4.
Okay.
Has there been any talk about that capital gain number being adjusted anywhere? Because that's very outdated.
It is. It's there's a lot of advocates that are pushing for it, but it really hasn't been brought up, I think, in any real serious conversations yet. But that's a big factor if you've got a senior that's been in their house for 40 years and they have
Prices have gone so much higher. That number is so unrealistic now.
I mean, you imagine, they're probably looking at it and saying, okay, if I have a $700,000 gain and I have to pay capital gains on $200,000, and then they think about moving even if they're downsizing and then having to maybe pay higher property taxes, it becomes unmotivating for them. So if they were to increase that, that's going to definitely help out. It definitely will. I think too, in terms of as we talk about seniors and baby boomers, there's some talk that they own a pretty large percentage of real estate. So the baby boomers account for roughly 21% of the population, but they own 38% of the real estate between their primary residence, maybe second homes or investment properties. In the next 8 to 12 years, you're probably going to see a lot of them either moving into retirement communities, they're passing away, and a lot of their heirs are going to be sitting on some of this real estate. So will there be more inventory down the line? Probably. Some might be held. A lot of that could be absorbed too. We do have a lot of population increases, so there's a lot of different things that can happen. But for right now, we do have these constraints right now on inventory, and I think that if there's some things that potentially could loosen that up, it'll help us all.
Okay, final thoughts from anyone? Michael?
One, just quick one. I was talking to an agent this afternoon. He was wondering about buyers' broker compensation out there, and if any lenders are willing to start, kind of rolling that into the mortgage. Have you seen any of that down the road or no?
They haven't allowed to roll that into the mortgage. We do have to show that on our loan estimates. So we have to go in and list it as any other expense, such as title or insurance or anything like that. So we definitely have to do that. I haven't seen probably much more than, I think, 3 to 4 deals this whole year in 2025 where we had the buyer's broker actually pay a commission. So it hasn't, I think, been as widespread as I think a lot of the people thought, or even any of us thought, after that the ruling on the lawsuit. So I think as the market moderates too, as we see maybe more of a balance, that maybe that'll be less and less of a concern. But we haven't seen it as yet. But there could be a talk that if that became more and more of an issue, I think if we had more and more buyers having to pay a buyer's broker, having to pay their agent's commission, I think there would have probably been a little bit more talk about seeing if they could have rolled that into the mortgage.
And then the last one here, just an elevator conversation length here, but I'm first-time buyer in here. So for our newer agents that are in here, what's your process of pre-approving a buyer? What are you looking for from that buyer?
Sure.
There.
Great question. So we typically, it's a very simple process. The agent will put us in contact with the buyer. Usually a lot of times I get agents that'll put me on a group text with the buyer, making an introduction. We will then connect with the buyer. We'll set up a time to, usually about 20 to 30 minutes, where we take down all their information, personal information, income, asset information, employment information. We run credit. We ask them for their last 2 years W-2s. We ask them for a month of their pay stubs. We do a quick calculation of what their income is. We actually run a credit report on them, and then we run it through the Fannie Mae Freddie Mac automated underwriting system. And that will then tell us if we have a preliminary approval on them. Then once we do, we generate a pre-approval. We'll send it out to the agent. That the agent then has it when they have to put together an offer on a contract. Usually it's a 30-minute process. It's just really being able to nail them down to a time so that we can get them on the line. And we can do it 2 ways. We can take the information over the phone from them. I also have a secure link that I could send them. That's on my email signature that allows them to apply and put all their information. And then once that's done, we connect with them and kind of finish off the process.
Right.
And for first-time home buyers, 3% down, conventional. 3.5 is FHA, and FHA, that's a, you don't have to be a first-time home buyer to use that FHA product, but there's a lot of times that FHA is used for those newer agents. That's just FHA, which stands for the Federal Housing Authority, allows for not only lower down payments, but for people that have average to below average credit.
Great. So with any additional questions pop in, Gino, from our at-home audience? No? Okay. So final wrap up on this. Again, we do appreciate, and Gino will put this together and send it out. We'll get it out by tomorrow, hopefully. And then you'll all be able to have a record of all of Ron's predictions, and you can write them down, and we'll be able to follow it up. It won't be like Bears predictions where we get immediate answers on these things. They're all a little bit more long term, but we do appreciate you tuning in. It's our job here in our goal to make sure that you get as accurate of information as possible, and also have quality individuals that you can work with. And Ron, as we spoke about earlier, longtime relationship with our company. He's the owner of the company at Chicagoland Home Mortgage Services. Been in the business for a long time. He has a lot of number ones on his resume. So congratulations to Ron for his productivity, not just on behalf of our office, but on behalf of many others that are in the business. And the one thing that I always admire with Ron is his responsiveness to our questions. And we know we're all in an environment where we need answers relatively quickly because of offers, and Ron goes beyond the call of duty to be able to get us that information. Plus his organization is top notch to be able to get these things done in a timely fashion. So that's why we've had a great relationship, and that's why our expert series, which Mike Rista is in the process of organizing, has started out with our number one expert, as we had mentioned before, Ron Ricchio. So thanks again, Ron, for your attendance this evening. And for all those in the audience and all those watching at home, thanks again for all of your participation. Let's have a great year. Let's keep moving forward. And we know we have a champion sitting in our corner right here with Ron Ricchio.
Thank you.
Thanks again. You guys have a nice evening.
Thank you.
Okay.
Okay.